Short seller Jim Chanos has warned that the real bubble investors should be watching is Chinese real estate. Economist Richard Koo goes even further and warns in new commentary that, quote, there will be blood in China in the real estate sector. Richard is the chief economist at the Nomura Research Institute. He is joining us now on the phone from Tokyo. Richard, thanks so much for being with us. You say there will be blood in the real estate sector. What do you mean? Do you mean that banks will have to absorb non-performing loans, or do you mean something worse, such as a housing crash?
Well, I must say that this time, I believe Chinese government is very serious about bringing the house prices down. In some Chinese quarters, ordinary apartments reached as much as $1 million for people who are making much less than in the U.S. or Japan. And the Chinese government is very worried that this may trigger another social unrest. And so they're very serious about bringing these prices down. And to that extent, we may see bankruptcies or collapses of projects. And, of course, some banks will end up holding a lot of non-performing loans as a result. Richard,
what kind of statistics are you following to tell you that all red flags should be raised? I mean, I know basically what you just said. Debts are low relatively for households, but real estate developers have much higher debts. I mean, is there some data point inflection that you're watching that signals a crisis?
Well, we already know that these developers are finding increasingly difficult to raise funds inside China. And now they're trying to raise funds outside China to stave off bankruptcies and inability to pay the bills. But I'm sure Chinese government will find ways to make that difficult as well, because I think these people are very serious. But at the same time, we have to remember that Chinese government does not want the Chinese economy to collapse with it. And on that score, Chinese government can put in more fiscal stimulus, which is really needed in this kind of environment to keep the economy going, by building more roads and railroads and things that China still needs. And so I think it's going to be a balancing act. They're going to let housing suffer, but they will try to offset that by pumping more money into social infrastructure projects, especially in the interior part of China.
So, Richard, I mean, you point out the power that the central government has, the People's Bank of China. I mean, it can ramp up rates, it can slow them down, it can add stimulus, it can take away stimulus. But how much stimulus, even in other areas, is too much? I mean, has the Chinese government already overshot?
Well, they definitely overshot. But you have to remember how it all started. After the Lehman shock, China almost lost 60 million people on the coastlines for those people who are working on the export sector. And if you lose 60 million jobs, and if you're running the country, you do anything to get the economy going. And they did the right fiscal stimulus, which was a great credit to them, but they also pumped a lot of money into the system through the banking system. And it's that part of the pumping money into the system that is now coming to haunt them through these house price increases. And so they're going to stop that banking from lending money to these bubbled sectors, but they'll probably continue the correct part, that is fiscal stimulus, to make sure that economy doesn't collapse with the housing bubble.
Richard, we only have time for a yes or no question. Are you confident the Chinese government can engineer a soft landing?
Yes, I think they'll be able to do it. And the key reason is that in democracies, it's very difficult to maintain fiscal stimulus in the medium term because, if one side is for fiscal stimulus, the other one is always for fiscal consolidation, and that makes fiscal policy very difficult to implement. But China doesn't have that problem. They fully understand what needs to be done, and I think they will do it.
Richard, thank you so much for the time. Richard Koo joining us there. He's at the Nomura Research Institute. He is the chief economist.